Welcome to Shareholder Primacy from Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. It's midsummer, and Ann and I decided to take a break from our break. End of summer. And Ann and I decided to take a break from our break and record some content for everybody. Ann, of course, Ann Lipton is, of course, the law professor at University of Colorado who teaches and researches securities and business law. She presides over the legal end of the podcast.
And that's Mike Levin, an activist investor who lives and works in Chicago. He covers the financial side of our podcast.
Well, hello there. It's been a few weeks since we've regaled everybody with our stuff. How's your summer going?
Ending. It's ending. Classes begin. We're recording on a Sunday. Classes begin for me tomorrow.
Oh, excellent! And
so that's why it's the end of the summer.
Did you get all your research done for the summer that you set out to? That's an embarrassing question. I won't ask. Sorry.
I actually got stuff done in the sense of the last couple of weeks were like the panic, buckle down, get stuff done.
Yeah,
so
we were trying to figure out when to record, and you're saying, not this day. I owe people something.
I've got to focus. Yeah.
All right, cool. That's great. So yeah, mine. Before you ask, mine's going great. Planning 2 or 3 projects for the fall. Can't talk about them yet. Wrapped up a couple already, but there's 2 or 3 have kind of started to emerge from their cocoons, from chrysalis state to full butterfly.
Okay.
So anyway, but otherwise we did a little travel and so forth. But I think
that's great.
I think as far as our schedule goes, we'll probably knock out maybe one more of these before Labor Day, which is pretty imminent, and then hopefully we'll be on a more or less regular recording schedule. Roughly weekly, depending on travel and so forth for everybody. So you can look forward to that. But in the meantime, there were a couple things we wanted to kind of cover for this week or this recording. First, there's been some consequences or fallout, whatever you want to call it, from the investment that the U.S. government, the Department of Commerce, made in Intel, the chip maker. That they made that investment about a year ago, and I think there's been some really kind of interesting lawsuits that have been filed over that.
One lawsuit, yes.
One lawsuit.
Yeah.
So we will talk about that for a while, and then there is a really unusual proxy solicitation that's taking place at Voya Financial. And there's a shareholder there that wants to put up a so-called no confidence vote resolution for Voya shareholders to kind of look at. So let's talk about both those things. All righty?
Yeah, and just quickly a reminder, we have an email address, shareholderprimacy@freefloat.llc. We've actually been sitting on a couple of emails because we plan on doing like a show that's just answering them. We will get to that, but we are not. So we do have your emails, and if you want to send more, shareholderprimacy@freefloat.llc.
Yeah, maybe before Labor Day we'll do a comprehensive mailbag clean out.
That would be nice.
And answer people's questions. That requires some thought, but it's a different kind of dirty secret among podcasters. Anyway, let's talk about Intel. And as a stock, and I was familiar with it for a while, just as an investment, it kind of sucked for like well over a decade. It was really kind of stagnant and didn't really go anywhere. And then it has jumped up a lot. The AI infrastructure boom and demand for chips and everything Intel does ramped it up. So in the 3 months from like April, May, June of this year, or March, April, May, it like tripled. And it's since declined, kind of giving back some of those gains. But it was a star of the first half, put it that way. Which helped us taxpayers, all right? Because for whatever reason, good, bad, or indifferent, we'll talk about that, the U.S. government made a $9 billion with a B investment in Intel about a year ago in August, acquired 10% of the shares, just under the threshold for whatever reporting might apply to the. I don't know if
exactly.
they're saying
is there doesn't have a short swing profit.
Is there a short swing profit problem that we have to talk about with the commerce? Probably not.
We don't have to talk about it, but yeah, they stayed below the threshold where they would have to.
Right. I'm glad someone was thinking, but there was still a D that was needed to be filed. I'm sure they didn't do that either. That investment is now worth approximately $40 billion. So that helps a little bit with our. But it's all on paper. It's not cash. But anyway,
to call it an investment is a pretty loaded term, because if you look at this from the plaintiff's point of view, the government didn't make any investment at all. They just got shares.
Oh, okay.
And that's really the problem.
Okay, let's talk about that. So, anything else about the investment that's worth noting? So, it's not like did the U.S. government send $10 billion and $9 billion over to Intel?
Well, not exactly. Yeah. See, this is why we have this dispute. So, yeah, Intel struck this deal to give the Trump administration just under 10% of the company new stock. And right now, a shareholder is suing over that, saying that this agreement is illegal. And the briefing on the motion to dismiss was just completed, so there's going to be an oral argument, and then at some point the court will issue a decision. And
this is in federal court?
It is in federal court, which is actually part of the story.
Okay, go ahead.
So just what happened, a lot of this was in news reports, but not all of it. The shareholder, Richard Paisner, did a 220 request in Delaware for internal records, and some of that made it into his pleadings. Now, some of it is actually still blacked out confidential, but there's some that's public. So what we know from news reports, and we also know from his own investigation. And this is sort of what happened. So Intel, as you said, makes computer chips, and exactly as you said, it's been falling behind in recent years. The stock has been under pressure. So under the Biden administration, Congress passed a law called the CHIPS Act, which provides funding to chip manufacturers like Intel in exchange for them boosting their domestic production. So the point is to get domestic production of computer chips. So Intel signed this deal, this contract with the Commerce Department, where it would get funding from the CHIPS Act in exchange for setting up these manufacturing facilities, which is all it had to do to get the funding, do this manufacturing stuff, which it did, or it was in the process of doing it, fulfilled its side of the contract. And then Trump takes office, and Trump announces that he doesn't like the CHIPS Act because he doesn't think the government should just give away funding. And he also doesn't like, like he doesn't think, even though the statute says funding, and if you set up manufacturing facilities, he thinks that's giving up too much.
Yeah, he wants an angle. He wants to get something more in the negotiation. It's the art of the deal.
You call it that. At the same time, he's very unhappy with Intel's CEO, Lip-Bu Tan, because Tan has these ties to China. And so Trump accuses him of being a security risk. He puts out a post on Truth Social that Intel has to fire him right away. Tan runs to Trump's office and has some kind of emergency meetings with Trump. And then a few days later, the Commerce Department goes to the Intel board with a term sheet. And the term sheet says Intel will issue nearly 10% of its stock to Commerce, and in exchange, Commerce will release this CHIPS Act funding, which it was supposed to get anyway.
Right.
And there was also, Commerce hands the Intel board a voting agreement where Commerce offers that if Intel takes this deal, Commerce is going to sign a voting agreement that says as long as Commerce holds the stock, it's going to vote its shares in accord with management recommendations. It's going to support management in all voting. And it's all very like mafia because Commerce apparently tells the Intel board that you should not, and this is the quoting from the complaint, Commerce tells the Intel board you should not make the mistake of thinking that this is a negotiation. Trump expects to announce a deal on Friday. And Commerce actually tells the board, we can't predict what will happen if you refuse, but the board should think very hard about the benefits of having a friend in the administration. And Commerce tells Intel if they agree, they'll now have the president's full endorsement.
So in the Commerce essentially converted a federal grant program, conditional. And I've actually been involved in these. I mean, this is very common. They converted it into a pipe.
Yes, they did, exactly. That's exactly
with a voting agreement.
With a voting agreement.
Which, depending on your perspective from a public policy civic affairs perspective, we'll talk about that. That's pretty bad.
Yeah, we will talk about that.
But just it's pretty resourceful if you're just if you're an Intel investor who's not part of this, you just got diluted out. So.
Well, that is exactly why there's a lawsuit. So 2 days
Right.
later,
anyway.
2 days, it takes 2 days for the boards to approve this deal. And it does that despite the fact, once again, according to the internal documents, that it was concerned that this is not legal, like literally not legal. And despite apparently being concerned about the economics. That's in the board minutes. The board was concerned about the economics. They were concerned about legality, but they didn't get any kind of assurance.
And we know that from the 220 demand.
Yeah, we got that from the 220.
Okay,
and,
all right.
But they signed it within 2 days without getting any assurance, without getting a legal opinion. Yeah. And after they signed, Trump starts telling people, Tan walked in wanting to keep his job, and he ended up giving us $10 billion to the United States. So he picked up $10 billion, which implies Intel didn't get anything in exchange for this deal. It just gave away its stock, which is why we now have a shareholder lawsuit.
Or Intel itself didn't get anything, but the CEO got job security.
Well, exactly, which is part of exactly what the shareholders' argument is, that this whole arrangement harmed the public stockholders. First of all, now everyone's diluted. Intel gave away 10% of the company for nothing, for money it was supposed to get anyway. So now everyone's stake is diminished. And second, the shareholders' argument is the board fundamentally insulated itself from shareholders because Commerce signed this voting agreement. Now there's a 10% friendly holder of the stock. And if anyone wants to vote out the board, if there was ever going to be an activist situation, because remember, this company was in trouble, that activist is going to have a lot more trouble because there's 10%
And it's been a subject
block.
of activist attention in the past. I can't remember who it might have been. Third Point. I can't remember who did it, but there have been other activists that have circled around Intel before.
Right. So the whole point is that this insulates the board. And that's exactly why the shareholder, Richard Paisner, files this complaint. Now, he actually filed it in Chancery, in the Delaware Court of Chancery, because Intel is incorporated in Delaware. But the defendants weren't just the board. He also named the Commerce Department and the Secretary of Commerce, Howard Lutnick, as defendants. And procedurally, that meant that the Commerce Department could move the whole case to federal court. So now it's in federal court in Delaware because the Commerce Department said, you're suing us and we get to move to federal court. So they did, which I think is going to matter. But we'll talk about the arguments. So the plaintiff's argument is that the board of Intel breached its fiduciary duties to shareholders in a couple of different ways. Yes. First, the contract is illegal. It's just an illegal contract because the CHIPS Act doesn't authorize the Commerce Department to take equity. Like the Commerce Department is saying we can do this because the statute authorizes us to take equity, and the plaintiff says no, it doesn't. It authorizes
it's
grants.
like a plain reading of the statutory language.
Yes,
should persuade anybody, including the federal judge in Delaware. Or is this probably isn't going to a jury? Is there a jury?
No, there won't be. It's not a jury case. But it's right. The federal judge. Well, right now it's on a motion to dismiss anyway, so that'll be the judge. But that and the plaintiff says, look, when Congress wants to authorize the government to take equity, it says so explicitly, TARP, things like that. Right. So here the plaintiff says this is illegal. And as we all know, in Delaware, it's a breach of fiduciary duty for the board to knowingly violate the law. And that's what this board did. So you can stop analyzing now. The board isn't allowed to break the law and give stock to Commerce. And also the plaintiff points out that the legal advisor to the board was Skadden. Now, Skadden was one of the law firms that struck this deal with the Trump administration to provide for legal for nothing. Like it wasn't like Trump administration hadn't even taken action against them. And Skadden immediately said, can we please give you $100 million in free legal work?
Right. So Skadden papered this deal for the government.
Exactly. So the plaintiff is saying Skadden was conflicted. You knew they were conflicted, and they, sort of led you into this deal that is illegal. So that's the first argument. And the second argument the plaintiff had is that the board acted disloyally because this was actually done to protect the board and TAN so they could keep their jobs. So Trump wouldn't try to force them out so they wouldn't be targeted. That's why they gave away the stock. And this voting agreement just shows this was actually about the board protecting its position, and that's disloyal. This is an entrenchment scheme.
Yes.
So what the plaintiff is asking for, what the plaintiff wants, he mentions damages, but what he really wants is to invalidate the contract, give the stock back, all of that.
Right.
And and I'll start before we talk about this legally. The Commerce Department has a lot of arguments based on federal law and the CHIPS Act and national security. They say federal law preempts Delaware law on this, that they have sovereign immunity, which means they can't be defendants, that this is all a national security issue. And I'm not going to weigh in on any of that because I am a corporate law professor.
Right. And we'll talk about the board and Intel's
we'll talk about the board,
obligations here, but not the government's. Okay, that's
not
fair.
all that. But except for this one thing, and this is about the court situation, I think Commerce made a huge strategic mistake right off the bat by moving this case to federal court. Because if you go and you make these arguments in the Chancery Court, a state court, and you say this is a national security matter, this lawsuit is preempted by federal law, Commerce is authorized to take stock, there's no way for a Delaware state court to decide that. I mean, it's hard for them. They're corporate law experts. They're not national security experts.
Right.
They don't really have a mandate to weigh in on these federal law issues. They don't have a great claim to authority to invalidate federal contracts. So I think in Delaware state court, there was a real chance the judges would just have not even wanted to entertain this, and they would have found some way to dismiss the case. But a federal court, that's all they do
that's
all
what they
day
do,
is
right?
tell the
This is
federal
their
government
job.
is violating the law. They've been doing that an awful lot lately. They say that the federal government is violating the law, and they enjoin the federal government from taking action. So I actually think it's better for this plaintiff that the case is now in federal court, because now he'll get a real
Well, now that they'll get an expert or more expert look at the claims against Commerce,
and a judge that's comfortable, if the judge feels it's warranted, ruling in the plaintiff's favor in a way that Chancery judges may have felt uncomfortable.
All right. So the venue is a little questionable here.
Yeah. So I mean, I think the plaintiff lucked out that Commerce made this mistake.
Right.
So the arguments. The first is the simplest. The contract is illegal, and once again, I will not express an opinion about whether the plaintiff is right that the contract is illegal. But let's assume, for the sake of argument, the plaintiff is right, that the CHIPS Act doesn't authorize Commerce to take stock. Now, we all know in Delaware, as we said, the board can't break the law. But what they can't do is knowingly break the law. And that's the key word, knowingly. So a lot of the board's argument is, you can't show we did this knowingly. We had a lawyer, we had counsel. The legal issues are complex. You can't prove we did this deliberately. So the question for the court is going to be not really just, is this contract illegal, but whether the board
it's
knew
a matter
that.
of intent.
Exactly. Was it reckless? Was it so obvious the deal was illegal? Was it so obvious that the board had conflicted legal advisors who couldn't possibly give them a good opinion and didn't get? They knew. We know that the board was concerned, and we know they didn't get a legal opinion.
Okay, but wouldn't the law, the statutory language, be that plain, or is it?
Well, that's exactly it. The board is going to say this is complex. What if it's this? And the court is going to say this is really. And remember, right now it's a motion to dismiss, which essentially means, has the plaintiff said something plausible?
Yes.
Like whether or I mean, it's slightly higher than that. But I mean, the court could easily say this is sufficient to move ahead to discovery.
Right.
Because right now the plaintiff has the 220 documents, but not real discovery.
They haven't deposed anybody. They haven't gotten probably much in the way of internal communication.
So the question, exactly. So whether the plaintiff has given enough to get to the next stage of litigation that the board did this knowingly, that's the first issue.
All right.
But then we get to the second issue, which is this entrenchment issue. Did the board agree to this deal to give away Intel stock to keep their jobs, to benefit themselves personally? And if so, is that a breach of the duty of loyalty? And conceptually,
I would think it would be.
Well, it's complicated because think of the board's position here. The Trump administration was threatening to withhold billions of dollars from the company. And maybe Intel really was entitled to this funding. It really had a contract to receive it. But if it had refused the Trump administration demands, then it would have had to file a lawsuit to get the money. There might have been years of litigation. And all that time, it doesn't have the money. And worse, it's making an enemy of its own regulator. And presumably the Trump administration can retaliate, deny it permits.
And it's losing. I mean, the investments that Intel makes are very long term.
Yeah.
They'll invest $9 billion, and this is probably one fab. I don't know what, I mean, in somewhere in Arizona or something like that. And they probably already spent a bunch of money on design and maybe some of the initial work on it. Okay, and it wouldn't come online for 3 or 4 years, and so they're already well into this investment. and we're probably counting on the $9 billion, as part of their cap structure and so forth. It just was critical. So
Exactly.
so they had a lot of economic incentive to say, okay, we need to do everything we can to get the 9 that we already started planning for and probably started building off of.
Exactly. It would have been risky, even if they're legally in the right. It would have been risky. Plus, again, retaliation, I think, was a very real issue.
Oh,
Not
sure.
just fire the board, but like the Trump administration would do whatever it could to
Right.
make Intel
Like,
suffer.
take the CEO's immigration status and probably give him a hard time. And there's all sorts of possibilities. Right.
Yeah. So you can see how a board could reasonably think, yes, it's better to just give this stock to the administration, even if it costs us the dilution to the shareholders, because that's worth it rather than fighting. That could be a reasonable business decision. We don't have to like it, but it's not crazy in terms of what's best for Intel. So that would normally be squarely within business judgment. And also, this is part of what's in the redacted filings. We can't see it exactly, but apparently Intel is claiming they did actually manage to renegotiate the contract a little bit in their favor, like accelerated payments or removing some contingencies, things like that. So they claim they got a little bit of improvements to the.
Yeah.
So anyway, and it turns out signing this agreement was great for Intel's stock price because it's not just about the AI situation. It's also, it looks like Intel is government backing now, and other companies are like signing contracts with Intel and they're investing with Intel because they know that Intel has U.S.
So it's like
government
the little
backing.
halo effect.
Yeah. And the thing about this, and this is where we get to the public policy issue of, I think this is bad for capitalism.
Absolutely. Yeah, this is no CEO, no board of a company in Intel's position wants the federal government. I mean, they're happy to have the grant money, okay, but because they've lived off of grants for decades in various ways. But this, public investment with a voting agreement, that's insane.
Well, it's insane for capitalism. I'm not sure it's insane for Intel. That's the issue. Here's the thing that now people want to invest in Intel because the U.S. government is there. They want to do business with Intel because the U.S. government is there. Now, that's bad in terms of innovation, just competitors. Competitors to Intel have less incentive to, they can't compete on the merits because Intel isn't winning on the merits. And now, if that gives all these boards an incentive to, why should I innovate my chips if I can just ingratiate myself with the Trump administration? I mean, it's just bad for competition.
Yes.
But that's not Intel's board's job. Their job is not to decide what's good for capitalism. Their job is to decide what's good for Intel.
And Intel shareholders.
Exactly. So normally this would all be classic business judgment. This is the decision we allow boards to make. But there's also the part where Trump was explicitly threatening the CEO and the board personally. And the way this actually unfolded, which again, we know from the internal documents, it looks like Commerce came to Intel and said, you give us 10% of the company, and as a bribe, as a sweetener, we'll sign this voting agreement. So now it doesn't look like this was a pure business judgment. Well, they have us over a barrel. Now it looks like the board was self-interested. Because there didn't have to be that voting agreement. For sure, if you're going to give away 10% of your stock to someone, the board could have legitimate reasons that buyer is going to then vote to oust them. They don't want to just hand their stock over with nothing, with no voting agreement, who's just going to vote them out. That's fair. But there are other ways to deal with that. So one thing, and this is what the plaintiff argues, they could have given non-voting stock. Or instead of a voting agreement to always support the board, it could have been a mirror voting agreement where Commerce votes exactly with the public shareholders. There are ways to take care of the problem of I'm handing 10% to somebody I don't want them to now turn to oust me without making it an entrenchment device.
Yes. Okay. So, that's the first argument. Okay, go ahead.
No, that's the second. The first one was about the illegality.
Okay,
so if that's what they've done, if the board had signed a given no vote stock or a mirror voting agreement, then the board could have a better argument that there was no self-interest. But with the voting agreement, it looks like there is self-interest.
But there's no evidence about whether they negotiated at this point. We just haven't seen it.
They didn't negotiate anything. This is 2 days.
Okay, all right.
And so that's basically the set of arguments. So a couple things about this. First, the way the plaintiff structured his complaint, there is a very real chance the court could decide to separate the voting agreement from the stock grant. The court could say, well, this whole thing is a problem. Let's move to the next stages. I mean, this is just a motion to dismiss.
Yeah.
But the court could also say that giving the stock to Commerce was business judgment, and it's only the voting agreement part that's the problem. And the court could separate those two pieces. But the other thing, and this is just like inside baseball legally, but for people who care about like the legal standards, this is weird about how the case is being argued. We've said on this show several times in Delaware, because it's Delaware law, if a board is self-interested, that's a potential breach of the duty of loyalty. And if there's no cleansing mechanism, which there wasn't, then the entire deal is examined for fairness, entire fairness.
Right.
We said this before.
That's the highest. That's the highest standard.
The highest standard that Delaware has. The deal is examined very closely, and that's what Paisner, the plaintiff, is arguing, that it was a self-interested deal and its entire fairness. And of course, the defendants, they say, no, this is business judgment. We made a reasonable decision that this was best for the company. But here's the thing. This isn't a normal kind of loyalty violation. This is a very specific kind. This is entrenchment, a board acting to maintain their seats. And this wasn't like they were selling their assets to the company or buying assets from the company, that kind of conflict. This is to maintain your seats. And normally, under Delaware law, when you act out of an entrenchment motive, that isn't entire fairness, and it's not business judgment.
Oh.
Normally, Delaware courts use an intermediate standard of review for that. That's called enhanced scrutiny.
Enhanced scrutiny. Okay, yes.
And under enhanced scrutiny, a board has to show that it identified a threat to the corporate enterprise and it acted reasonably to diffuse that threat. So I just have to quickly mention, there's no other case exactly like this, but the closest that I can come up with is a case not long ago called Edgio. Edgio, there was a company, it was a lot of financial trouble, very possibly could have been a target for activism. So to save the company, the board decided to make an acquisition to buy another company and pay with stock. 33%. It was going to issue 33%, a lot, to Apollo. That was the seller of the company that they wanted to buy. And they wanted to make sure that Apollo wasn't going to turn around and take its 33% and oust the board. So they made Apollo sign a stockholder agreement to always vote for the board of directors and also to never transfer its stock to anyone on a list of activists. There was a list of activists, and Apollo couldn't sell their stock to it. So the shareholders sued, and the court agreed this is enhanced scrutiny, not entire fairness, not business judgment. Now, that case is obviously different. For one thing, in that case, the plaintiffs were only challenging the voting agreement, not the acquisition. And also the board was the one who came up with the agreement. It was much more intense than the one here. But still, if we follow Edgio, we would say this is enhanced scrutiny. And enhanced scrutiny, it's just not as stringent a test. It's also possible the board could say something like, we identified a threat to the corporate enterprise. Trump was going to damage the company. We acted reasonably under the circumstances. We were in a rush. Commerce was the one who suggested the voting agreement. And the board could say it's only 10%. And it barely makes a difference anyway, because who's going to do an activism while the U.S. government holds 10%? It's not going to happen. So. But the thing is that no one's really arguing for enhanced scrutiny because the plaintiff wants entire fairness and the defendants want business judgment. So there really isn't much briefing on the enhanced scrutiny. So it's a weird situation. And that's basically where we are. Well, there'll be oral argument, and then the court will make a decision.
When's the oral argument scheduled?
It hasn't been scheduled. They just requested it.
So this is going to be a while.
Yeah, and the court, the court either dismisses the case or part of the case, or the court says you move on to later stages. Like there won't be, the court's not going to strike the whole agreement or anything.
Right, and this is federal court, which moves a lot more slowly.
It's not chancery, it's the move. Mm-hmm.
Right. Oh, wow. All right. So this is kind of interesting because activists see this kind of stuff, like I said, in pipes. Yeah,
you're right. It's a pipe.
We'll see a pipe that totally screws over all the other shareholders, and this doesn't. I'm not sure this screws over shareholders. But it
depends on how you look at it. The dilution absolutely does, but on the other hand, having the U.S. government backing, as bad as that is for general capitalism and competition, may very well turn out to be very good.
It was good for Intel. Look what happened to the share price. Anyway. Yeah. All right. Let's leave this one there, and we'll take a quick break. And when we come back, we'll talk about Voya Financial here at Shareholder Primacy.
Shareholder Primacy is brought to you by FreeFlowAnalytics.com, the only free database of corporate directors, their influence, and their performance. If you own a stock or retirement plan, go to FreeFlowAnalytics.com and look up which of your elected directors are performing well and which aren't. Use your vote in the alternative democracy and get your data at FreeFlowAnalytics.com. Now, back to the show.
Welcome back to Shareholder Primacy. I'm Ann Lipton here with Mike Levin. And we are talking about a weird situation at Voya Financial, which I guess was a wealth management firm that was spun out of...
is a wealth
management firm that spun out of where?
ING.
ING. Okay, financial, and it's. I guess you would know better than me, but it's doing well.
Yeah, well, it's fine. So Voya's kind of had a very stagnant few years before this year. This year it's up like 42%.
Okay.
They got spun. I think it was public company created in 2013 after ING spun it out, and now this activist investor has come along with something that we really haven't seen very much of, or none of.
I haven't heard of it
in the past, and it's quite an unusual proxy contest and solicitation. The activist is called Tom's Capital. And let's talk a little bit about some of the dimensions of the investment. So Tom's Capital owns about 4.5% of Voya. Voya is about a $9 billion market cap company, so they own about 4.5%. And Tom's Capital is about a not quite $4 billion fund. So their investment in Voya is about 13% of its AUM, assets under management. Mm-hmm. And they have some experience, Tom's, as an activist, but it's really quiet. They've done some activist investing projects at Target and a couple other places, but it's nothing where they've been filing anything in the form of a 13D. As far as I can tell, they've never done any kind of proxy contest before. So they have experience in terms of pressuring management, but not experience in proxy contests, and certainly mm-hmm. what they have in mind here. And what they have in mind is asking shareholders to vote on a no confidence resolution.
Okay, what is a no confidence resolution?
Yeah, right, that was my question. It's pretty vague. I'm going to read you the resolution. So they are putting this resolution in front of shareholders. Resolved that the shareholders of Voya Financial, Inc. no longer continue to have confidence in the board of directors and management of Voya Financial, Inc. That's
okay.
it.
We don't
That's
have
the whole
confidence.
thing.
All right. Okay, but this isn't Parliament.
No, right.
Confidence doesn't require the directors to
Right. So there's a few dimensions to that which are very curious. And this could either be, for some reasons, this could become inspired and really achieve some really interesting objectives in a very backdoor kind of way.
Okay.
Or it could just be stupid and futile and cost them a lot of money in ways that they could have easily avoided spending.
How are they doing this exactly?
Okay. So normally, as we all know, with a resolution, this is precatory. Okay, mm-hmm. Just by the words of it, there's nothing.
We are saying we have no confidence.
It doesn't obligate the company to do anything.
We are expressing our emotions.
Right. So instead of submitting this to the company for the next AGM, and the last one was just this past, was in April. They'd have to wait, several months. Okay. They're going to have shareholders vote on this resolution at its own meeting. So Tom's is organizing and convening a shareholder meeting. It's going to be virtual.
Okay.
So it's not like there's going to be, coffee and swag at some hotel ballroom somewhere. It's a virtual meeting. But Tom's is organizing a shareholder meeting, and they're going to solicit proxies of shareholders that can't attend the meeting, which is a little hard to believe because it's virtual.
Right.
But anyway, there'll be people who vote by proxy. And the sole purpose of this meeting is to vote on this matter, this one resolution. And
so they're calling they're a shareholder, and they are calling their own shareholder meeting.
They're gathering,
they're calling shareholder meeting.
Right, invitation going out to all shareholders to attend this meeting. And look, they're doing this quite seriously. That they have expensive lawyers. I hired Okapi Partners, which is a really high-end, really good, they're badass proxy solicitor. Mm-hmm. So they're quite, they got a commitment to the bid here. What's a couple other things that are worth noting about why they're kind of doing it this way is Voya in its bylaws does not allow shareholders to demand a special meeting,
right,
or to conduct written consent solicitations. So the only way if Tom's wanted to, do this in the normal channels, they could do anything, is to, put this up is possibly as a 14A8, but I don't see how 14, that would
they
happen.
they could do it their own, universal proxy
or something,
but
right.
they would still be waiting.
Yeah, you have to wait till mid next year. And there's, for whatever reason that Tom's has not quite yet expressed, there's a sense of urgency.
Do we know when this shareholder meeting is taking place?
Not yet. Okay. They've only filed.
This is not an official company meeting, but nobody can stop a shareholder from just saying, "Hey, shareholders, want to get together on Zoom?" There's no mechanism to stop them.
That was my one of the questions I had. I can't think of a reason why this would be illegal.
It can't possibly be. I mean, first of all, the interesting thing is that back in the day, now I'm not a legal historian, but my understanding is that back in the day, like early 1900s, late 1800s, it actually wasn't unusual for stockholders to kind of do things like form stockholders committees that would investigate the board or take some kind of action, essentially on their own without board sanction. So this is really a throwback to that.
Sure.
But certainly, there's no possible way that it can be that would be a First Amendment problem. Of course, they have the right to assemble if they want to.
Yeah, people,
it doesn't necessarily.
Especially because it's non-binding. There's nothing.
Right, exactly. It doesn't have any legal significance in the sense it can't bind the company in any way. It's not an official meeting. But Voya can't possibly invoke the law to prevent shareholders from getting together.
Voya has said that they're planning on seeking some sort of regulatory relief or something.
What?
I don't know. So Tom sent out its preliminary proxy, and then Voya immediately says a news release.
I really want them to sue to try to enjoin this so that Tom's can make a right of assembly First Amendment.
That'd be fun.
Please, oh please.
Yes, right. But that was Voya's news release was saying we're exploring regulatory options or something like that. And, they sent out, this is not sanctioned. This is not the company. Right. So the other question is, what else could Voya do? Well, Voya could solicit an opposition.
Right.
Okay. And if I was advising Voya and I wrote this, I'd say, why bother? This is crazy. What a waste of money. Let the shareholders meet. There's nothing binding about this. All they're doing is basically assessing sentiment, which we'll talk about in a minute. Okay? Just let them meet. Voya is undoubtedly sufficiently concerned about what this looks like and its own image that it will it will almost certainly solicit an opposition. They're going to hire industry. They're going to hire some major solicitor. Right.
But I think that that's exactly the problem. I don't think they can. I mean, I don't know. I can't swear they won't find some way to stop it. But it does seem like that's going to be very difficult to do. So now you're stuck. If you do nothing, there's a chance you get this. God knows what the numbers look like. No confidence vote looks really bad for the board and invites further activism.
Right.
But if they solicit against, they're sort of validating the meeting, validating this tactic.
Yes, exactly.
And which is also bad. It gives Tom's more credibility. And what if they still lose?
Well, so here's the likely outcome. Well, first let's talk about what the vote will mean. And so. For what it's worth, Tom's has said there's a voting standard. Every time you put one of these out, you got to say how do the votes count? And they've basically said they're going to count the votes for and the votes against. Broken down votes don't count, and so forth.
Abstentions aren't part of it.
Don't count, right? And so
they can make up any voting standard. They could say 1/3, and it means it passes. It's not a real meeting.
Yes, correct. So they're and they said they'll report the. Results publicly. They'll report the results to the company. Mm-hmm. I would kind of expect if it starts to go really badly, they'll just kind of quietly walk away for this. Yeah, that would be kind of silly. But
I gotta think they wouldn't do it unless they thought.
Yeah, they probably have. And they've already started criticizing the company and so forth. And it'd be really easy if you're a shareholder who's sort of seen 5 or 6 or 8 years of mediocre share price performance. It's non-binding. It's not like voting against directors. You could vote in
the only thing you're saying is that you might at some future date support an actual proxy contest.
That's what's interesting about this is that Tom's is spending again, and I think in all the proxy statements you have to say what the expected if you're in In contested ones, you have to sort of put out a number about how much you're planning on spending. And
you don't have to do any of that. I don't even think the proxy rules apply. The proxy rules apply for a vote. This isn't really a vote.
Right. Well, that's right. Yeah, I'm not sure they even had a file proxy statement. On this,
exactly. They didn't. I mean, I understand why they want to, but like they're not soliciting their vote at an actual shareholder meeting. You don't have to.
Exactly. So they've said they're going to spend $5 million on this. And again, those numbers half the time are all fictional anyway.
Yeah.
But
I did not know that.
Yeah, $5 million on this vote, which is if they were to earn the kind of the standard 1% on their position, that's significant. That's decently more than the fees that they're going to earn from their limited partners on this. So they're spending $5 million to potentially learn what shareholders kind of think, which they could do from making a few calls.
Right.
So
well, they want to. I mean, presumably they think. I mean, I don't know how they game this out, but maybe they think if they can make a show of force to Voya, they can bring Voya to the table, and that would be and that could be done more cheaply than a for real actual proxy contest.
Well, that's the thing is that if this were to somehow settle, I don't know what settlement would look like. It's not like you're settling for board seats or something like that. They'll probably their broad demand was to kind of break up the company, do some sort of a strategic review. So Voya could promise that and do it. And, half the time those don't even wrap up or, don't get to anything meaningful. And then that might make, the shareholders that voted for this happy. On the other hand, this is where this could be really interesting. This is kind of like a dry run of a proxy contest.
Yeah, exactly.
Okay.
And it brings the board to the table.
Yeah, right. Yeah, absolutely. Gets the board. Certainly got the board's attention. Okay. But so what's going to happen is Tom's is going to, spend this kind of money, and they budgeted $5 million. They don't have to spend all that. Okay. And they'll start to, and while they've said they're going to disclose the votes, the aggregate vote publicly, they're going to learn, and they're going to have in-depth discussions with a lot of shareholders in a kind of, I'm not going to say protected, but sort of protected because it's a proxy solicitation way. And they're going to be able to learn all sorts of stuff about what shareholders are thinking. That information, they don't have to, and would be crazy to think that they would share that with the company. So they're going to talk to, dozens or potentially hundreds of shareholders through Okapi and learn all this about what, really in-depth information about shareholder sentiment that they might not otherwise have been able to get in a proxy contest. And Voya's got to know this, that they're going to have one very smart shareholder about what's going on. They're going to know more. Tom's is going to know more about the Voya shareholder base than Voya knows. And even though shareholder support, like for say on pay-in directors, was overwhelmingly positive in the past, 2, 3, 4 years, Tom's will be able to start to, level some criticism against the company and say, hey, what have you thought about this, that, or the other thing, and so forth, and probably get attention from some of these. There's undoubtedly going to be some shareholders who are going to say, I don't know what this looks like. The big indexers will probably say, we have no time for this. This isn't for us. But they might not. They could get interested in this. We'll sort of see what happens. That's why. I mean,
it really. The thing is that it just raises so many questions for me about like the legal standards here. Given that it's not really a shareholder vote, do the index funds even have to report how they voted? I mean,
this is not. I don't think this is an NPX. This is not reportable.
Right, exactly. NPX. I don't think any of the proxy rules apply. It's not really a vote. They can choose to follow them for their own reasons, but it's not a vote.
It's interesting. Will the proxy advisors do an analysis of this? Will they wait?
No.
I don't know. I mean, how do you vote on this anyway? You don't have to. This is nothing.
Your pretend meeting.
Yeah. Right. So anyway, that's why this could go in a couple different directions. And again, if the vote's close, what does that mean?
Yeah.
It's really hard to understand what constitutes a successful vote here.
Right.
Is a majority in favor after all the overwhelmingly supportive votes of management over the past few years? Is that meaningful, or is the majority in favor of this vague resolution meaningless?
It's really got to be about participation rates, because the reality is that since this isn't actually a shareholder meeting, you're probably only going to bother to vote if you're voting with Tom's. So they could win a majority of those voting, but if the number of actual shares voting is 1%, that's meaningless. So
that's a very good point.
So the number who actually participate in this,
there's no quorum here.
Matters
it's just
a lot.
whoever shows up. So anyway. All right, so that's Tom's. So we'll have to sort of see when they schedule this. Again, it's only at the preliminary proxy stage. But I am keenly interested to sort of see what what other filings look like. And, they got a website if people want to look. This is a big deal. Tom's, to their credit, Tom's is taking this quite seriously.
No, of course.
This may be the only thing, this may be, unless they wanted to wait many months for a shareholder meeting that if there was a threat that Voya would undoubtedly try to postpone. Maybe this is the best thing they could do. So anyway.
Yep.
All right, so we'll stay tuned on this one, all righty?
Okay.
Cool. Let's wrap up. How about that?
All right.
This is Shareholder Primacy, hosted by Ann Lipton and me, Mike Levin. I'm an independent activist investor and advisor to investors about their activist situations. Ann is professor of law and the Lawrence W. Demuth Chair of Business Law at the University of Colorado Law School. You can find me, Mike, at theactivistinvestor.com and Ann at law.colorado.edu. Thanks for listening. We'll talk again soon.